Hi everyone, my name is Nur Shazwani Nordin, student of Bachelor Finance. For this video, I will be talking about 16 most common candlestick patterns and how you can use them to identify trading opportunities. In financial technical analysis, a candlestick pattern is a movement in prices shown graphically on a candlestick chart that some believe can predict a particular market movement. Candlesticks are graphical representation of price movement for a given period of time. They are commonly formed by the opening, high, low, and closing prices of a financial instrument. If the opening price is above the closing price, normally red or black candlestick is drawn. If the closing price is above the opening price, then normally a green or white with black outline candlestick is shown. This green or red known as the body. It can be long, normal, or short, depending on its proportion to the lines above or below it. The lines above and below known as tails. It represents the high and low price ranges within a specific time. However, not all candlesticks have tails. I will be explaining 3 types of pattern, which are bullish candlestick patterns, bearish candlestick patterns, and continuation candlestick patterns. First off is 6 bullish candlestick patterns. Bullish patterns may form after a market downtrend and signal a reversal of price movement. They are an indicator for traders to consider opening a long position to profit from any upward trend. The hammer candlestick pattern is formed of a short body with a long lower tail and is found at the bottom of a downward trend. A hammer indicates that while there were selling pressures throughout the day, a strong buying pressure ultimately drove the price back up. The color of the body can vary, but green hammers indicate a stronger bull market than red hammers. Inverse hammer. It is similar with hammer candlestick. The only difference is the upper tail is long while the lower tail is short. It indicates a buying pressure followed by a selling pressure that was not strong enough to drive the market price down. The inverse hammer suggests that buyers will soon have control of the market. The bullish engulf pattern is formed of 2 candlesticks. The first candle is a short red body that is completely engulfed by a larger green candle. Though the second day begins lower than the first, the bullish market drives the price higher, resulting in a clear wins for buyers. The piercing line is also a 2-stick pattern, made up of a long red candle, followed by a long green candle. There is usually a significant gap down between the first candlestick closing price and the green candlestick opening. It indicates a strong buying pressure as the price is pushed up to or above the mid price of the previous day. The morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It is a 3-stick pattern, one short-bodied candle between a long red and a long green. Traditionally, the star will have no overlap with the longer bodies, as the market gaps both on open and close. It signals that the selling pressure of the first day is subsiding and a bull market is on the way. The 3 white soldier patterns occur over 3 days. It consists of conservative long green candles with small tail, which open and close progressively higher than the previous day. It is a very strong bullish signal that occurs after a downtrend and shows a steady advance of buying pressure. Bearish candlestick pattern usually form after an uptrend and signal of a point resistance. When traders are extremely pessimistic about the market price, they quite often close their long position and open the short position to take advantage of the falling price. The hanging man is the bearish equivalent of a hammer. It has the same shape but forms at the end of an uptrend. It indicates that there was a significant sell-off during the day, but that the buyers were able to push the price up again. The large sell-off is often seen as an indication that the bulls are losing control of the market. The shooting star is the same shape as the inverted hammer, but is formed in an uptrend. It has a small lower body and a long upper tail. Usually, the market will open slightly higher and rise up to an intraday high before closing at a price just above the open, much like a star falling to the ground. A bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a long red candle. It signifies a peak or slowdown of a price movement, and it is a sign of an expected market downturn. The lower the second candle goes, the more significant the trend is likely to be. The evening star is a three-candlestick pattern that is equivalent of the bullish morning star. It is formed of a short candle sandwiched between a long green candle and a large red candlestick. It indicates the reversal of an uptrend and is particularly strong when the third candlestick erases the gains of the first candle. The three black crows candlestick pattern comprises of three consecutive long red candles with short or non-existent tails. Each session opens at a similar price to the previous day, but selling pressures push the price lower and lower with each close. Traders interpret this pattern as the start of a bearish downtrend, as the sellers have overtaken the buyers during 3 successive trading days. The dark cloud cover candlestick pattern indicates a bearish reversal, a black cloud over the positive previous day. It comprises two candlesticks, a red candlestick which opens above the previous green body and closes below its midpoint. It signals that the bears have taken over the session, pushing the price sharply lower. If the tails of the candles are short, it suggests that the downtrend was extremely decisive. If a candlestick pattern doesn't indicate a change in market direction, it is what is known as continuation pattern. This can help traders to identify a period of rest in the market when there is market indecision or neutral price movement. When a market open and close are almost at the same price point, the candlestick resembles a cross or plus sign. Traders should look out for a short to non-existent body with tails of various lengths. This doji pattern conveys of a struggle between buyers and sellers that result in no net gain for either side. Alone a doji is neutral signal, but it can be found in reversal pattern such as the bullish morning star and the bearish evening star. The spinning top candlestick pattern has a sharp body centered between tails of equal length. The pattern indicates indecision in the market, resulting in no meaningful change in price. The bulls send the price higher while the bears push it low again. Spinning tops are often interpreted as a period of consolidation or rest following a significant uptrend or downtrend. On its own, the spinning top is relatively mild signal, but they can be interpreted as a sign of things to come, as it signifies that the current market pressure is losing control. Three method formation patterns are used to predict the continuation of a current trend, be it bearish or bullish. The bearish pattern is called the falling tree method. It is formed of a long red body followed by three small green bodies and another red body. The green candles are all contained within the range of the bearish bodies. It shows traders that the bulls do not have enough strength to reverse the trend. The opposite is true for the bullish pattern, called the rising tree methods candlestick pattern. It comprises of three short reds within the range of two long greens. The pattern shows traders that, despite some selling pressure, buyers are retaining control of the market. That's all my explanation on candlestick pattern. Thank you for watching.